Hello everyone and welcome to the fourth quarter. Today is October 1st, 2018, and I welcome you to the quarterly scouting report. My name is Adam Koos. I am President and Portfolio Manager at Libertas Wealth Management Group in Columbus, Ohio. Let's go ahead and dive right into this today. First of all, just the normal housekeeping. Let's make sure we've got your screen set up so you can see these charts and the visual aids that I'm going to be showing you pretty easily today. All you want to do, you're looking at YouTube, is sit here bottom right. You've got a gear button. You click on that. And you just want to make sure that it's set to the highest quality possible. It might say 720p, it might say 1080i, it might say 1080p. Whatever the highest number is, that's what you want to have it set to. And of course, because this is YouTube and it is a video, you can always go back and forth, rewind, watch it over. So I will apologize in advance. I tend to speak extremely fast because we want to try and make this as short as possible while at the same time getting as much value across as humanly possible as well. So again, let's without further ado, let's go and talk a little bit about the market this year. So year to date, we're sitting on October 1st. It's the beginning of the fourth quarter. And as you can see here on the left-hand side, we've got the start to 2018. We had a very low volatile year last year in 2017, which kind of continued through a good part of January, at which point we had an extremely fast correction. In fact, one of the fastest, if not the fastest correction that we've seen since 1913 on the S&P 500. So a very, very fast correction to start February here, in fact, most of February. At which point we saw momentum down here in the bottom pane become extremely bearish. That high, we've been watching that high for a really long time throughout this year. I say really long, I guess I mean 7 months, we'll call it. And finally, right here in August, we had a breakout. In other words, we had the S&P 500 break north out of that previous all-time high, as well as just a little tiny peak here into bullish momentum, which is defined by RSI 14 going north of 70. What we really want to see at this point, now that we've seen the S&P 500 or the market pull back to what was previously a ceiling of support, a ceiling of resistance now becomes support. So now that we've seen it pull back and then bounce off that line, we want to see the market continue up from here. Furthermore, with momentum down here in the bottom, we've got that little peak of bullishness down here. We want to see, as it's pulled back and consolidated, we want to see momentum follow through to the top side. What we don't want to see is we don't want to see momentum start to weaken here going into the fourth quarter. That would definitely not be good. But bottom line, things still look very good right now. There's really nothing that I'm seeing here on this chart that tells me that the market should be in any way bearish or in any way should anybody be nervous or worried about a crash coming next week, next month. Really, the next few months, as far as I can see, based on price, momentum, strength of trend, all look very, very good right now. If we move forward, this is just a strength of trend chart down here in the bottom. This is called ADX. Or it's a combination of directional movement. With the black solid line is what I want you to focus on here. And when the black solid line is high, that means whatever trend that's in place is very strong. So you can see here way back in January, we had really strong trend coming out of 2017, and that trend started to weaken. I don't think that's any secret. This entire summer and really a good portion of 2017 has been all about getting back to those all-time highs and trying to break north of them. So this horizontal rectangle that we see here again is the same support and resistance we were looking at on the previous page. The red line is the 50-day moving average, so a 50-day trend, and the blue line is the 200-day trend or the 200-day moving average. So what we have here right now is a break to all-time highs, a pullback to what was previously a ceiling of resistance, which now becomes a floor of support. We see another all-time high and another pullback. That's the market breathing. That's healthy. That's totally fine with me, and it should be totally fine with everybody watching this video. The market does not go up in a straight line. That never happens. And then we've got price. In other words, the market trading above the 50-day. So above the 50-day trend, we've got the market trading above the 200-day trend. We have the 50-day trend trading above the 200, and both of those are sloping up. As I mentioned on the previous slide, we've got positive momentum, bullish momentum, so that's good. And the only thing that I'd like to see get a little bit better in these first two charts anyway is for as the market continues higher, because that's what we want to see, right? We want to see higher market prices here. We want to see the ADX turn positive. Right now we're looking at a value of 10, give or take, call it 2 points. That's a very, very weak indicator, telling us that things are still pretty trendless. So what we want to see is that trend start to increase, and we want to see the market continue higher from here. Next, we'll look at something I showed everyone at our halftime update at Ohio Stadium at the recruiting room when we did our client appreciation event this year, and that is a comparison between the New York Stock Exchange, the price of the NYSE, which, as you can see, has not even gotten back to where it was in January. We're probably 2/3 of the way there, if I had to guess, just eyeballing that. But what we see here and what we've seen this entire year is a continuation of participation in the market. So up top here is price. In other words, we've got the big dogs. We've got the generals, we'll call it. So the NYSE, the S&P 500, all of these indices are typically cap-weighted indices, which means that the biggest names, the biggest companies on the index push their weight around. When the big companies go up, the index goes up. When the big companies go down, the index goes down. So it doesn't give enough equal participation or equal weight to the smaller companies. And the smaller companies is what you can see down here. So the AD line, or advanced decline line, is telling us basically the total number of advancers, all advancing stocks on the NYSE, and then we're subtracting from that all of the declining stocks. So it gives no weight to the heavier weighted companies. Basically everybody gets an equal weight. So it's kind of like if we look at the top and we consider the top to be Congress, where every state in the union, so to speak, gets a different number of congressional members based on the size of the state. The bottom is the Senate. Every state gets two senators. So we can see here that all the way back, we'll call it this summer, May, June-ish, we had a breakout, and you can see the NYSE hasn't broken out yet here. If we look all the way up here to this past month, September-ish, we've got higher highs, higher lows all the way up, but we still haven't seen a breakout to all-time highs on the NYSE price movement. So the only thing I don't want to say nervous about, but the only thing that concerns me here a little bit, it's way too soon to say anything, is that we do see a lower high here in the AD line with a higher high in price, and my guess is that's just telling us that we're seeing the bigger companies follow through with some momentum this past month, and that the small caps are taking a breather, which again is totally healthy. So we want to see this AD line at the bottom continue higher to new all-time highs, right along with the price of the NYSE Composite Index. The next few slides I want to show you they're not a new concept, we'll say, but an acquaintance, a new friend of mine who I met a few years ago in New York City at the CMTA conference that I attend every year, which is the Chartered Market Technician Association conference, is Julius de Camponer. He invented this concept as an analyst years and years and years ago, way before it became popular. And I hesitate to say it's become popular yet, but it's becoming popular, is something called a relative rotation graph. Julius wanted to figure out a way that you could visualize sector rotation, asset class rotation, and he was able to do that through his research, which is proprietary. And back in January of 2011, which is not that long ago, so just 7 years ago, the RRG, or a relative rotation graph, became officially on the Bloomberg terminals, and then it was released to stockcharts.com in July of 2014. So this is really becoming a new concept here, but I wanted to show you an animated graph because it really kind of encompasses what this analysis does. Right off the bat, if you look at this, it's on repeat for 13 weeks. I want you to ask yourself for a second what you notice about what the stocks, which is each one of these arrows and the letters or symbols. What do you notice about the stocks on this sheet? What direction are they moving? And then I'm not going to leave you in suspense because nobody's going to talk to me back here on a screencast, but they're moving clockwise. Now, with some very, very rare exceptions, all these stocks, this is the S&P 500, all the members of the S&P 500, compared to the S&P 500 as an index, which is at the middle, the 0 point. So in the upper left, we have improving, as you can see up here. Then we have leading the index, weakening versus the index in the bottom right quadrant, and then lagging versus the index in the bottom left. So what this RRG, or relative rotation graph, is showing us is visually how stocks on the S&P 500 move from improving to leading to weakening to lagging most of the time on a cyclical basis. Now, in the past, there's been tons and tons and tons of studies done on relative strength, sector rotation, and the fact that the market does rotate through sectors and asset classes over time. but Julius was the one that was really able to kind of put together something visual that was very easy to see. And what we've started to do here this past few years is build strategies using testing through a piece of software called Optima, and looking at direction. In other words, what direction the arrow is pointing. So obviously we want it pointing toward the northeast, or in other words, toward the leading quadrant. We've looked at the direction of movement. We've looked at velocity. So each dot that you see here is 1 week. So if you see a bunch of little dots over the course of 13 weeks, that means it really hasn't moved that fast. If you see a lot of movement, obviously that's high velocity, that's high relative strength. So there's lots of things you can look at, and a lot of things you can test to try and give yourself an edge in terms of what investments you own at any particular time. You can do the same thing on the Dow. So it's not like this is limited to just the S&P 500. So here are all 30 stocks on the Dow. I did not animate this because I wanted to keep it simple, but the story is the same here. You can see how the arrows are pointing in certain different directions depending on the relative strength at the time. You can see Intel right here is lagging. Caterpillar is lagging. 3M is starting to improve. Procter & Gamble looked like it was improving, but it looks like it's starting to turn down here. While we've got Pfizer, Disney, Verizon are starting to move toward the leading quadrant, meaning leading the S&P 500, which is at the 0 point again here in the middle. We can take it further. We can even go up to a 30,000 foot view. We can go to the moon, and we can look at the S&P 500 here again in the middle versus the Dow, the Russell 2000, which is small caps, the NASDAQ Composite, and the NASDAQ 100. So you can see here that the Dow is kind of starting to come up into improving. Maybe we'll see. But small caps, the Russell 2000, are very obviously leading the market still. And by the way, folks, you can't have a market crash when the small companies are doing well. Usually it's the opposite. When markets crash, the S&P 500 is one of the last indices, the Dow one of the last indices to crash. It's usually small companies crash first, then mid caps, and then last large caps. So enough about relative rotation graphs. Let's one other little tool here that I think that is fun to share. This is a relative rotation graph candlestick chart. Again, Optima is a piece of software that I use that it gives me the ability to pretty much take a blank canvas and program anything I want into this. And being somebody who's colorblind, I can't just use any colors, so I programmed Optima to tell me on a candlestick chart when a particular stock, in this case AMD, is lagging the market in red down here. And by the way, if this isn't orange, I'm going to embarrass myself, but gray is improving. Blue is when it's leading. And then you can see here weakening is in orange. At least I hope it is. And then at least it doesn't matter to me. As long as I can tell the difference, that's all I care about. But leading again, so you can see how AMD went from leading to weakening and then turned right back up into the leading quadrant, and now it's sitting in the weakening quadrant currently as of the last few weeks. Down here we've got a 200-day moving average or a 200-day trend, along with an average true range stop, which I'll keep to myself. I use specific numbers here that I particularly care about, but I don't think any of you will. So what's really neat about this is you can really kind of visualize when a stock is lagging, how it's performing relative to what it's doing when it's leading, weakening, leading, and so on. Typically, what you see is when a stock is leading, it tends to move into the weakening quadrant. Many times, however, it'll move right back into the leading quadrant again. So again, if I go back here the NASDAQ, it's in the weakening quadrant right now, which if I go back again, that would mean it would be in orange if we were looking at a candlestick chart, an RRG candlestick chart. But it very much could turn right back around and head back into leading again. So it doesn't have to go into lagging, but generally speaking, it is a clockwise movement when you're looking at these RRG charts. So moving on from stocks to interest rates, here is a really, really long chart. This is going back to the late 70s, and you can see obviously a very clear downtrend in interest rates. This is the 10-year Treasury. We saw a couple peaks northward of this trend, and obviously a trend lines, guys, diagonal trend lines are very subjective. So I don't tend to use them a lot, but when it comes to a multi-decade chart, I think it's pretty easy to draw one. And you can see how we saw the 10-year Treasury peak north of this trend line a couple times here, and it just did it again. But what's most important, really, I think, on this chart is that we saw two bottoms that are relatively close to one another for the first time in many, many, many years. So the question here is, are we going to see interest rates pull back to the trend line and then head higher from here. And if I had to guess, if I had to give an opinion, I would think that's what would happen. But again, I'm not a trend predictor. I'm a trend follower. So I'm not trying to predict what the market's going to do here. I'm just taking the weight of the evidence based on what the market is telling me, and what interest rates are telling me right now is that we're starting to see a rounded bottom, and that this breakout here above this trend line could very well hold. And if it doesn't hold, my guess is we're probably not going to see interest rates fall back down to the 1.5, 1 3/4 range again, unless we were to see some ridiculous market crash where federal funds rates were dropped to negative, let's just say, for instance. So interest rates, again, as they go up, bond values go down, which is, again, why many of you who are not clients of ours, if you own a lot of bonds in your portfolio, you may notice that you've had a struggle this year in your portfolio. Balanced portfolios, conservative portfolios, target date funds, things like that. The more conservative you are, you have to be more, I think, very, very careful about what kind of fixed income instruments or investments you're purchasing and holding on to. And I think that it's going to take a lot more tactical approach going forward to managing bonds and fixed income than what we've seen in the past. Because in the past, all we've seen is a 30, 40-year bull market in bonds, because we've seen a 30-year plus bear market in interest rates. When, again, interest rates go down, bond prices go up. But interest rates, if they're bottoming out here and we start to see higher rates, then bonds are going to go down in value. It's no question. It's not a matter of speculation. That's just how it works. Change gears here to gold. Let's just talk briefly about gold for a second. This is a chart that goes back to just late 2013. You can see some divergences here in momentum. So momentum going up, higher bottoms of momentum, where we have lower lows in price, and then we have a big spike. So that's typically what happens, is you see price follow momentum. It doesn't happen all the time, but it happens a lot. So as we have higher highs in momentum, lower lows in price, price follows momentum higher, and we get this kind of big bounce from 1050, we'll call it, to 1370, 1380 in gold. Then we have kind of two flat tops. So a top here and another top that does not exceed the previous top. But we have negative divergence, short-term negative divergence in gold, and then it goes down. Again, same thing here. We have two tops, and then negative divergence down here. Gold goes down in price. Now, most recently, we've had a really, really steep decline, a low here, but we've had two flat bottoms in momentum. Now, that doesn't necessarily mean that gold's going to spike from here, but my guess is that we're going to see gold continue to contain itself here in this rectangular box between, call it 1380-ish and 1050 or so. If we see prices get much below 1130, 1120 on gold, I think that's a problem. If it breaks down below 1050, which I would think it would take some time to do so, I think we got gold bugs. Gold investors have big problems on their hands. But gold investors, no big deal when compared to Bitcoin, right? So if any of you know anything about what's going on in Bitcoin, since the peak back in December, the Bitcoin has gone down 79.1% as of Friday's close. So there is nothing that I see on this chart that looks good. We've got a price. Remember earlier we were talking about the S&P 500. Let me go back to that here real quick. So again, the S&P 500 is trading above the 200-day. The 50's above the 200. Price trend, everything's sloping up. That's all good. Again, all we want to see down here at the bottom is a little bit more indication of strength of trend. But when we're looking at Bitcoin, it's quite the opposite. We see price trading below the 50 and the 200. We see the 200 trading below the 50. We see this dotted line is the 252-day moving average, which is the one-year trend. That is sloping down. We see bearishness on momentum going back to June with no sign of life whatsoever. It's sad to me, the people that I know personally, and some others that I'm sure are out there that I see in Twitter and I see in social media continuing to believe that Bitcoin is going to become the new reserve currency, or that that they want to hold on to their Bitcoin because they feel like it's going to come back. And I'm telling you folks, I mean, it's investing 101, trading 101, risk management 101. It doesn't really matter what you call it. Anytime you say, I think an investment's going to go up, I think Bitcoin's going to come back, I really believe in Bitcoin. When you say things like that, you are totally screwing yourself. You're married to the investment at that point, and you're not going to sell it. And the reasons you're not going to sell it are all wrong. You can't keep an investment because you like it, or because you believe in it, or because you think it's going to go up, or some investment report you read that you happen to find online. Which, by the way, if you want to find negative analyst reports online, do a Google search for negative analyst reports and you'll find them. If you want to find positive analyst reports online, do a Google search for positive analyst reports on Bitcoin, and you'll find them. You can find analysis that will support your opinion all day long. The only thing that is going to give you objective analysis is looking at a chart, the supply and demand relationship, whether or not buyers are buying, sellers are selling, where the enthusiasm is. And looking at this chart, I don't know that. I mean, my 8-year-old could tell me this isn't a downtrend, and that you probably wouldn't want to put your money into this. Another way to think of this: if you had $1 million right now in cash in the bank, would you put that $1 million into this investment today? So in other words, you have no vested interest whatsoever. Would you invest in that today? And I would hope the answer would be no. So I don't mean to beat up Bitcoin so much, but it's really a pet peeve of mine when I see or hear about people talking about how they believe in an investment, or they shop at so and so store, so that's why they own Target. Let's just say, not to say there's anything wrong with Target right now. I don't even know what the chart looks like, to be honest. But point is, never put your heart into a stock. Emotions are no place for investing. Period. Same with politics and so on. So, in closing, let's just kind of wrap the day up here. I want to look at some seasonality. This is Stock Trader's Almanac. Jeff Hirsch has done great research for years, looking at seasonality studies, historical studies. And as you can see here, when we look at midterm election years, this is an average, the S&P 500's price movement average over the course of a midterm election year going back to 1850. So this is taking every single midterm election year, just like the one we're living in right now, and it averages out all the price movement each and every time that we've had a midterm election year to give us an average. So what we typically see at the beginning of the year is kind of a pop in the very beginning, then weakness going into February. Then from February through mid-April, you can see how we have a move from, we'll call it down 1 3/4 to about up 2.1, 2.2% before it just kind of weakens from mid-April, late April, all the way through, we'll call it July. Then the summer's typically flat. Nothing really happens. So if you go back to January, you can fast forward all the way to October, call it the first 2 weeks in October, before you see any net positive movement in the S&P 500 in the stock market here in the U.S. So what I really want you to pay attention to here, though, is the last quarter of the year. So today, again, October 1st is where we are. We'll probably publish this and send it out tomorrow, October 2nd, Tuesday. But as I record this is typically, this last 3 months of the year, typically the best 3 months of the year for the stock market in any year, let alone midterm election years. But midterm election years also tend to do very well. We're also in a year where we had a positive Santa Claus rally. That's the last few trading days of the year and the first few trading days of the new year. We had a positive first 5 days of the year. And we had a positive January. That's called all three things, not in the midterm election year, but in any year, the Stock Trader's Almanac calls that the trifecta. So when all three of those things are positive, we tend to see really, really positive years on average in the stock market. So that's not to say that this couldn't be different, but this summer so far has been pretty good, when normally it's supposed to be bad. August and September are their worst 2 months for the stock market in midterm election years. September is the worst month for the market in any given year, and we've seen a positive August. We've seen a pretty good August and September combined. So I think that says a lot of good things for the rest of this year. I think all the doom and gloomers, I think that the people who are trying to use fundamental reasons or debt crises or trade wars and tariffs to scare people into investing their money or to scare them into selling their investments, I think that that's not only selfish but somewhat unethical. And I think that what you want to do is you want to look at the charts. I think you want to look at the weight of the evidence, supply and demand. And right now, I don't know what else to say other than that bulls are in charge. There's not a lot of bearishness out there. And I think that we'll probably see a pretty good end to this year. At least that's what the weight of the evidence is telling me. That's what the market's telling me. And again, we never want to fight the market because you'll always lose that battle. So that's all I've got for today. If you have any questions, feel free to give us a call. If you'd like a second opinion on your retirement plan, your financial plan, estate plan, your portfolio, please, by all means, we offer free second opinions. Reach out to us. One of my staff, one of our financial advisors will connect with you. If you have any personal questions for me, feel free to email me personally. You can email that general info box at libertaswealth.com. My staff always forwards that to me in the case that the email is directed at me personally. Feel free to follow the company on Twitter at LibertasWM or myself on Twitter at Adam Koos. And then we've got our Facebook page, which we try to do our best to post charts and opinions on all social media, all three of these mediums as often as possible. But sometimes it gets quiet when there's not a whole lot to say. But it's facebook.com/Libertas Wealth. So thank you so much for watching today. I hope you learned something new. If you have any questions for the end of the year, we'll be doing our market outlook in January for 2019, believe it or not. Meanwhile, enjoy the fall, enjoy the cool weather, and enjoy your holidays. I hope you have a wonderful, relaxing holiday season, and I'll talk to you soon.